Hi everyone, Andrew here again. In this short video, I'm going to explain a little bit more about trusts and how they can be beneficial in a financial planning, but particularly an estate planning perspective. Now, trusts enable you to control the timing of capital to beneficiaries, usually children, at a time when you think they are ready for it. So it might be that you got to a situation, a point in your life where you've got surplus capital, might be sitting in a bank account and not keeping up with inflation. And so you want to make use of it. And you've also got an eye on inheritance tax, and you don't want your estate to pay inheritance tax unnecessarily on capital that you have. So you can use trusts to make that stepping stone between you having the capital and giving it to beneficiaries, your children, possibly at a time when they might not be quite ready for it. It might be that they're still young and so won't be able to handle a significant capital sum. Perhaps they're adult, but they're just not financially mature enough yet, or maybe they've got learning difficulties and may never be mature enough to handle capital. So you can use trusts then to control the timing and the amount of payments that they get. Now, trusts are also beneficial if you've got concerns about the relationships that your children might be in. Maybe they're married, but you're concerned about a future divorce, and you don't want your money to be split in a divorce settlement to your children's husbands or wives. So trusts give you that element of control as well. Now, there's two main types of trusts that we use in estate planning and financial planning. If you speak to a solicitor, there's lots of nuance around it. But in this situation, to keep it simple, I'm going to explain two different types. The first one is what's known as an absolute trust or a bare trust. And the second type is a discretionary trust. So with an absolute trust, the beneficiaries are known absolutely, and so when they get to a particular age, usually adulthood, they have a specific right to the capital. So it's normally used where your beneficiaries are still under 18, because when they are adults, they have a legal right to the money, so they could just call it in if they know about the trust's existence. So a discretionary trust, on the other hand, as the name implies, gives you more discretion around when the payments out of the trust are made. So it can still be that your children or grandchildren are the intended beneficiaries, but because they're not named absolutely, they can't call the money in. So you might put money into a discretionary trust now, a large capital sum, and at any point in the future when you think they're ready for it, you could pay the whole sum out, or you could pay the money out in installments over a number of years. You have that discretion. Now, when you make payments into the trust, you are the settlor, and you'll also be a trustee. But it's good practice to have at least one other trustee who can act on your behalf to make sure your wishes are carried out when you die, if you survive the other trustee. So that's a very short video, as I said, on the use of trusts and the different types of trusts and how they can be beneficial when you're thinking about passing money to future generations. If you've got any questions, please do get in touch.